The World Bank recently released the Gold Investing Handbook for asset managers by the Deputy Managing Director at the Central Bank of Uzbekistan, who is a member of their investment committee. Now, this document provides a clear and compelling explanation of why central banks are diversifying from the dollar to increase their gold reserves. The report shows that central banks often boost their gold reserves following financial sanctions from powerful countries like the US. Econometric analysis in the study reveals that the amount and value of gold reserves typically rise after sanctions from major global economies such as the Euro area, Japan, the UK, or the US within the same year or the preceding one. The handbook cites historical data indicating that central banks most concerned about Western sanctions, particularly after the Russia-Ukraine conflict, are actively buying gold. The reason is simple. Gold is a physical asset that can be kept within a country, offering security against the risks of foreign currency reserves being frozen by international sanctions. The report notes that significant increases in gold reserves have often occurred 1 or 2 years after a country faces sanctions. Other increases have been responses to political instability like financial crises or coup attempts, confirming earlier research findings. The handbook points out a notable shift in 2022 as central banks around the world increasingly focused on expanding their gold reserves. This rise in interest wasn't solely a response to sanctions. It was also driven by a series of market disruptions, including the 2008 global financial crisis, trade tensions between the US and China, the complexities of Brexit, the global impacts of the COVID-19 pandemic, prolonged periods of negative real interest rates, and ongoing geopolitical tensions. These factors together highlighted the importance of gold as a crucial safeguard against financial instability. It refers to a 2022 survey by the World Gold Council, where asset managers emphasized gold's historic role and its performance during crises as key reasons for including it in their portfolios. It further explains that studies show a direct link between the escalation of geopolitical risks and the rise in gold prices, even when considering financial market volatility. This research distinguishes between anticipated or perceived geopolitical risks and actual realized risks, with the latter having a stronger impact on gold prices. Other studies he mentioned indicate that reserve managers see gold as an essential hedge against both economic and geopolitical uncertainties, prompting them to increase their gold reserves during times of heightened risk or uncertainty. The handbook also suggests that these trends may indicate the start of a new financial paradigm, reshaping global approaches to economic security and stability. It concludes by saying that we might be on the brink of a financial revolution. The handbook discusses the idea that following Russia's supply-side crisis and the resulting sanctions, the world is moving from the Bretton Woods system, which was supported by gold bullion, to Bretton Woods II, which relied on international money like treasuries, which have risks of being seized, to a new phase, Bretton Woods III, which is supported by external assets like gold bullion and other commodities. He believes that the sanctions on Russia are encouraging central banks to move away from the dollar towards gold and prompting governments to exchange their dollar reserves for other commodities. It is important for us to know that gold's share in global foreign reserves can dip down to 30% sooner than expected, risking the chances of the US losing its dominance. There was a time when such a drastic prediction would automatically be dubbed as a delusion. However, with the recent developments and tangible evidence of the US dollar slowly but steadily losing its dominance in the global financial system and other countries wanting financial independence, a new financial system is inevitable. The good news is that in each possibility that the report mentioned, gold will be the vital part for all of the reasons the report already mentioned. This makes gold a necessary part of your portfolio. It is the best hedge, always has been, and always will be.